Rahul Arora, CEO of Ashika Institutional Equities, joins in. Rahul, we'll have to do a bit of a rapid fire here. Good morning, because we have the Commerce Minister interview lined up in just moments from now. But just wondering, Rahul, now that we've got some affirmation of the trade deal, or at least the agreement details being out, do you reckon is that something that could get institutional clients, especially on the foreign side, back into the Indian markets?
Morning, Neeraj. Thank you for having me on the show. So I think, Neeraj, this is more directed towards FDI rather than FPI, is my sense, because I think the FPIs would rather be watching the currency very closely, Neeraj. As we were discussing on the budget day, I think Nifty earnings are projected to grow at about 12-13% next year. If you have a 3-4% rupee depreciation on that, add to that LTCG and adjust it for their home inflation, that's not much of an arbitrage left over the US 10-year yield, which is coming to you at 4.5%, which is a relatively safe asset. So I think the trade deal is definitely a positive. We are still going through the fine print. New details are emerging every day. But I think net-net, it will probably be more FDI positive rather than FPI positive, is my sense. Because even though valuations have reset a little bit on the way down, Neeraj, I still think there is a phase of consolidation ahead for the markets.
In terms, Rahul, hi, Tamanna here. In terms of some of the corporate earnings that we've been seeing, do you think that the market has not yet accounted for improvement in earnings that we've been seeing in Q3?
So I think, Tamanna, morning. So I think a large part of it is going to be determined by the fact that the base is so low, right? So even a rate of growth, sorry, let's just take QSRs, for example, right? They had a dream run on one day last week where the stocks were up anywhere between 5 to 15%. Even a 3, 4, 5% same-store sales growth was being cheered. But on what base? It was a low single digit or a negative base. But take a look at State Bank of India this morning, which is your highest gainer on the Nifty, up by about 5%. Even there, we're factoring in a growth of about, if you take, say, between FY25 reported and FY28, the earnings are projected to grow by about 14-15% after such a good quarter, despite a 66% growth in, other income. So my sense is that I think the good thing, Tamanna, is that the upgrade to downgrade ratio is stabilizing. There was a period for about 2 years where the downgrades were more than the upgrades. I think that's approaching parity, or even slowly will move in favor of the upgrades. But I still don't think I'm confident sitting here saying that, see, almost 75% of the index is BFSI, IT, consumer, and Reliance. If you take these 75-80%, I don't think between these four you're going to look at more than 12-13% kind of earnings growth. So even if the balance of the market grows at 15% plus, which barring auto seems difficult, it still won't move the needle in a very material way, according to me. Therefore, the cautious optimism.
Cautious optimism. Rahul, morning, Alex here. So from that perspective, let me ask you what you are bullish on. If you think that a period of consolidation, and you've described ably the reasons why you anticipate that that will take place, but there will still be some pockets of strength. Where are they?
Well, absolutely, Alex. I think consumer discretionary is still holding out well. I think, liquor stocks, hotel stocks, aviation stocks, I think they will continue to do well. I think hotel rates are still holding very strong on the ARRs. I think if you look at the aviation data in terms of occupancy and ticket rates, they're still holding extremely firm. And I think, Alex, after the shocker that you saw in case of ITC, and the concerns of regulation re-emerging, I think some amount of that money did find its way into liquor stocks. So I think consumer discretionary would certainly be one pocket. As I was telling Neeraj and Tamanna earlier, I think PSU banks are still not the most expensive in the world. I think SBI, if you look at the street, nobody is valuing it at more than 1.7, 1.8 times. That's a full one-time lower than what your large cap private sector banks are trading. So I think there could be some value that emerges there. I think defense stocks are given a decent correction. I think we can look at that. And lastly, I think automobiles, the monthly sales numbers are very strong. Of course, you can argue that GST rates were cut a couple of months back, and therefore that has held up well. But I think automobiles could be an interesting place as well. So I think if you nibble in the leaders, say an Indian Hotels, Indigo, UNSP, I think an M&M, Maruti, something like an Eicher, you could make a reasonable portfolio. And State Bank of India, like I said, these are some places. In defense, you can take your pick. I think Mazgaon Dogs, HAL, BML, BEL, BDL, all look fairly interesting after the fall.
Rahul, exporters have had a rally already, right? Last week, a clutch of them went up 30-40%. Now the belief, this trade deal, whichever details come out, you know that in some sense, the negativity around the US exporters is likely out of the system. Does the 40% gain bake in the positives, or do you reckon there are still some buckets out there which might be good to log into because the price destruction was very stiff?
So I think, Neeraj, see, a lot of these companies that you're referring to, textiles, jewelry, leather, footwear, have working capital and debt-related issues. So obviously, at a later date, we can go into a detailed dive as to which and what. But I don't think that post the run that you've seen that there is too much juice left in these companies to play them for. If at all you want to play them, you can play them, say, through the jewelry side, where I think some of the companies are managing their P&L and cash flows a little bit better. You can look at a Titan, Kalyan, TVZ over there. I think leather as a space, Neeraj, has been ignored by the market for a very, very long time, partly for their own fault. But I think if you have some action returning to the likes of Relaxo and Bata, these stocks have been dead for a very, very long time. And, they're fairly cash-rich companies and don't, have reasonable market share and good recall value. It's just, I think, product launches and online that has come in the way. But I think if I was to focus on two related sectors from the export standpoint, it'll be jewelry and leather. And within that, those 4-5 stocks that I have named, those would be my focus areas, both from a valuation and a growth standpoint, as well as from a balance sheet and P&L standpoint.
Okay, I'm just trying to understand, Rahul, for a lot of people who were hoping for the trade deal to be the final sort of push, the tailwind, right? If you're thinking about what was the biggest woe for Indian markets the last few months, the lack of a trade deal with the United States was one big reason. Do you see a pivot from here in terms of how the markets move and maybe more positive sentiment coming in?
Like I said, Tamanna, I don't think this is going to be a year where you're going to have great returns. I think at best from here in the balance 10 months of the year, 10 and a half months, I think if you get a 10% return, that'll be great. That's about 1% average every month. We'd be lucky to get that. So I think, my own sense is that the high for the year could be somewhere around 27, 28,000. I would be very surprised if we get past that. Of course, a lot of it depends on how earnings pan out as we go along. There's a summer season coming up. Durables and electricals have been out of it. They make a comeback? What are the IT companies going to be saying somewhere around the Q1 results? In terms of how budget spending is moving with relative to AI, that's going to be extremely important. And then, of course, in a couple of months, we're going to look up to the heavens again and see what kind of monsoon predictions we have for consumer staples. So I think this move itself is done. I think if you're expecting anything more to happen on the market from a trade deal perspective, that's history. So also, I think the fall related to STT on the budget is history. So I think whatever has happened in the market has happened positive or negative. I think it's going to be back to earnings. And like I said, unless you have material upticks on the way here, it's going to be very difficult to make a case. Going back to the point I made earlier, when you're getting a 10-year US at about 4.5%, and even T-bills just south of 4%, look at the way the Japanese bonds are doing, Indonesian bonds are doing. So we're not just competing for capital with other equity markets, you're competing with alternate asset classes.
Yes.
And don't for a minute think that, gold and silver is out of the equation. As Indians, we don't give up on them very easily.
Yeah, that's fair. Rahul, I'm going to wait for the next few months and to see whether or not that lack of bullishness changes and that cautious optimism changes to actual optimism. Thanks so much for joining us as always. Pleasure speaking with you.
Likewise. Thank you for having me, Alex.